Here's a look at the headlines that we are tracking at this point in time. After announcing a 20% TCS or international credit card usage, government has faced pushback. It has come out with clarifications. We will discuss those clarifications and more on the show today. And SEBI has also proposed a uniform total expense ratio for mutual funds, which means that mutual funds are going to be more transparent regarding cost they charge to unit holders. Also on the show, Indigo on Thursday reported a profit of 919 crores, which was a record quarter for Indigo as air travel boomed. And Swiggy has also declared its results. It's turned profitable in the March quarter of financial year 2023. All those stories and more on this edition. With me is my colleague Karthik Malhotra as usual.
Hi,
Karthik, hello Karthik. A good day to you. We're starting out with what we seem and are looking at as clarifications coming in from Ministry of Finance after that late night notification wherein they introduced a 20% TCS on international credit card usage. A lot of pushback on Twitter, on Facebook, people asking what should we do? Should we stop traveling even for client meetings? Not just for leisure purposes, but also for work purposes, because all in all, every form of credit card usage will be charged, except for educational and medical purposes.
So one thing is clear, and that is what I think is apparent in the social media rancor also around this, that nobody's happy with this move, right? And a lot of corporate voices have come out, including the likes of Mohandas Pai, who are saying that if your end goal really was to try and track the spends that individuals are making outside, there's no reason to make it as high as 20%. The same can be done at 2% or any amount, any percentage which need not be as high as 20%. Simply because this 20% burden is directly on the spender, on the traveler. So I think some interesting clarifications that came out later yesterday were that number one, this move is being done to make credit card usage come at par with forex cards and debit cards as well. Right. So, of course, the 20% hike now becomes irrespective on whatever mode of payment you're using other than physical cash. So, it's applicable on debit cards, it's applicable on forex cards, it's applicable on credit cards as well. But the justification to get credit cards into LRS was given that now it becomes completely at par with other means of payments made abroad. Right. Another important facet that came out yesterday was that corporate travels on corporate cards or on business tours are actually going to be exempt from LRS. So the debate that was hot until late evening yesterday, when we were also talking about this on our show and after that, was that how does a seller in any other country distinguish between a card being swiped belonging to an individual or belonging to a company? So now, of course, there is going to be a lot of work to be done on the tech infrastructure to make this distinction clear. But the circular clarified yesterday that any corporate expense or any business tour is not under the remit of LRS.
Okay. So we are only talking about leisure travel?
We are talking about holidays, individuals traveling for leisure, for tourism, for family vacations, for meeting family, for anything else. So that, of course, is the, but just to sort of, for our audiences who are joining us today who perhaps missed this debate yesterday, this rule becomes applicable from the 1st of July. However, even present day, starting 16th May, a 0.5% up to 5% tax, TCS, tax collected on source is applicable not on credit cards, it's applicable on debit cards and forex cards. Now, from 1st July, the tax collected at source on any international travel goes up to 20%. And this is going to impact anybody who's taking a trip outside Indian shores from the 1st of July. A $10 bill is going to cost you $12, a $100 bill is going to cost you $120. This cost is, of course, a temporary cost because this additional 20% delta is collected by the bank, deposited into the coffers of the government. But eventually, when you reconcile your taxes at the end of the financial year and when you file your taxes, you either get an adjustment or a refund, as the case may be. Okay. So, for example, if you fall in the bracket of, let's say, 20 lakh rupees annual CTC, taxed at, let's say, 20%, which is the prevailing rate, that is exactly the rate applicable on credit cards as well. So your credit card outgo on, let's say, a 1 lakh rupees spend happens to be 20,000 rupees. When you reconcile your taxes for somebody who is in the 20% tax bracket earning 20 lakhs per annum, 4 lakh rupees being the outgo, this 20,000 gets adjusted and your tax outgo will be 3 lakh 80,000 additional tax outgo.
Okay. A couple of reasons mentioned in the FAQ that was sent out by the ministry yesterday. One, that is, this payment is not a final tax, which essentially alludes to what you were saying, that you can reconcile this tax. I have two qualms about this, and this is on the basis of what people as well.
I have many more than two, so I'm glad that you have only two.
I have two, and this is in line with what many people are saying online. Number one is that 20%
is too high.
Is a tad too high.
That's what Mohandas Pai alluded to, exactly this. He said the same tracking. What is the government's reason to do this? Sorry, I'll come to your second point also. What is the government's real operational reason to get something like this moving? So, some data which the government has disclosed, Finance Ministry has disclosed, the details are still awaited, but a headline figure of $24 billion in FY23 have been remitted internationally. The Finance Ministry statement states that 50% of this is on foreign travel, right? So that's a sizable $12 billion. I think the government is very interested to know where this money is being spent. I think the hunch that the government is working on, I could be wrong, I don't know, this is my reading between the lines, but my hunch is that the government assumes that a lot of spends are happening internationally exceeding the LRS threshold of $250,000 permitted by the RBI per annum. So the assumption could be that people are investing in property, but while they are investing in property, some additional component related to that property is being swiped on a credit card. So once these granular details of credit card usage become available to the government, it is able to track through that, draw some inferences on what other spends are being incurred by a particular taxpayer or tax evader, as the case may be, internationally, which is otherwise difficult to track for the government. But
fact,
it can be done at 2%, it can be done at 0.5%, it can be done at 1%, it can be done at any value, and 20% is bound to hurt people like you and me.
And you are absolutely correct, you're bang on, because the notification says that instances have come to notice where LRS payments are disproportionately high when compared to disclosed incomes.
That's right.
Essentially, you are trying to find tax evaders.
That's right.
Through this information, and if that was the sole purpose, then 20% could have been a 5% or a 10%, and you would still identify who the tax evaders are.
Okay, as long as, as long as this is targeted to HNIs only, right? 20%.
But you're assuming that only HNIs go abroad.
That's a wrong assumption.
Absolutely.
I mean, you could have HNIs living in 5 stars, traveling business class, but people like you and me, when we travel cattle class. We look for budget deals. We travel on a shoestring budget. And what this is also likely to do, and in fact, I read a statement of one of the tax partners at EY also this morning, it's going to compel people, hopefully not us, but a lot of people looking for cash deals on dollar exchanges.
That is true.
So with demonetization, with this entire, ease of payments within the country, internationally, with internationalization of UPI, with international credit cards available easily through banks which do your KYC, there was no reason for affluent travelers to really go and convert cash and look for forex deals in these little fly-by-night sort of operators sitting in nooks and corners of markets. You would get your basic dollars from your bank and you would carry your plastic. It was as simple as that. Today, people will be, you constrain the limit of somebody's expenses. If you have a budget of 1 lakh, you incidentally have to now cut down that budget to 83,000 rupees because 20% goes straight to the government.
Absolutely.
So people will look for steal deals and people will look at ways to evade this, which is not going to be healthy for the country.
And I think one of the ramifications of this, as you rightly pointed out, is that people will take to having more cash in hand, and that in itself results in a lot of problems on ground, carrying more cash anyway, not encouraged by the government. So you're going against your very basic principle of what you've been discouraging locally, domestically. You're hoping that people going abroad will carry more cash, and resultant fears of cash loss, theft, etc. come with it.
And where is that currency exchange happening? Again, it's not happening through the banking channels. People who have surplus cash, see, why are you doing this? Let's come back to the basics. You're doing this to catch the tax evaders. Tax evaders traveling abroad, swiping credit card, you want to go after them. That being the basic sort of foundation of, presumed foundation of why this is being done. The same guys will have cash available in their local currency in India, will now go to a local forex exchange house, exchange it for dollars, make the same payments in dollars. So we still continue to suffer, right?
Absolutely.
You had a second concern also.
Not doing any good. My second concern, and this also alluded to the fact that, you know, firstly on the side of we as individuals ending up paying way more than what we were paying up until now if we are transacting. Another concern was with respect to what government is hoping to do with this, which is to keep the money with them. And this is again, it comes back from what they have written in that FAQ. And they say that if TCS is a taxpayer or TCS Pay is a taxpayer, he can claim credit for the TCS, as we were discussing, against the regular income and adjust it against whatever advance tax you've paid. So essentially you can claim it back.
Correct.
But after a year, which means government keeps that money interest-free loan.
Absolutely.
And that is another major concern, because if you wanted that money, there were other ways of getting that money as opposed to, you know.
Well, actually not too many other ways, because, you know, you can only get it by way of advance tax or eventual tax filing that, that citizens, tax-paying citizens or corporate houses do. So, yeah,
so this actually masks the intentions.
You've amassed 20% of presumably $12 billion of outgo expected if the travel rate remains the same. Of course, you know, last year we also saw higher travel because of the post-pandemic sort of, you know, this whole you live your life only once, YOLO sort of a thing, and people went on an outrage in travel. And this was
the
also sort of
revenge,
pent-up demand, revenge travel, revenge holidays. So that went up, but let's assume it continues to be the same. So you're actually getting a good 20% of $12 billion as advance tax, interest-free, you know,
and this also comes on the back of the fact that I was talking to a travel agent yesterday, and he said in as many words that half the people traveling abroad don't even know that they're paying this TCS, which means that they will never claim it back. So this money will stay with the government, because not every person is aware about claiming their, you know, filing their taxes, claiming back the money.
So I think all the tax that gets collected at source here, because your credit card willy-nilly is linked to a bank account, in the statement, the AS26, form AS26 that gets generated every quarter, these transactions automatically appear there. So I think reconciliation will not be very difficult. You will not need physical bills.
But that is for people who are aware of the fact that they are paying as much.
Anybody who is filing taxes on the income tax portal and using bank statements as an indicator of how much tax has been paid, and therefore calculating how much is balanced, these numbers should reflect automatically. Anybody filing tax through a chartered accountant will also, you know, the CA will very easily be able to decipher this. So I don't think there's going to be a challenge of claiming this money back or adjusting this money back with or without awareness, because it's pretty much like interest you get on fixed deposits. It is taxable, it appears in your form AS6. Or, you know, any other sundry source of income that came that had a tax deducted at source, it gets reflected in your form AS6. This becomes one more figure or 100 more figures number of times you swipe your credit card in the form AS26AS, and that gets sort of, you know, readjusted, recalibrated. Should not be a problem. So one thing to note, of course, is that, again, for the purpose of our audience, if you have, you know, a child studying abroad or somebody who receives medical attention or medical care internationally, while it fits under the ambit of tax collection at source, the rate of 20% is not applicable, and it doesn't even sort of, you know, so there are two clauses here. If you've taken an education loan or a medical loan, then the tax collected at source is at 0.5%. Not 20% as is the case with credit cards, it's at 0.5%. However, if you have not taken a loan and the money being spent internationally on education or medical expenses is out of your own savings, out of your own money, then there's a 5% TCS. These two also have a limit, a threshold of 7 lakh rupees per annum. So anything over and above that 7 lakh rupees directly comes under the ambit of LRS and will be taxed at 20%.
That is correct, and those are very important Figures, very important information for all those who are hoping to, take a trip abroad in the month of July, because remember, it's not just your credit card spend that will now be taxed at 20%, also your foreign trips and tours starting July. So it's going to get more and more expensive for those who are planning a leisure travel in the month of July. So the time to travel, therefore, is in the month of June.
But the hitch there is flight tickets are already expensive.
Already expensive. So there you have it. Government making it difficult for you to travel, perhaps take to traveling within India. That's also another motive that is being attested to this move.
So heads you lose, tails the government wins.